right, the next question that we commonly get, again, these are for sellers, are what is the capital gains tax on the sale of a home and how can I minimize it? We hear this a lot.
Okay, so we do have the principal residence exclusion, which is up to $250,000 on a single taxpayer or $500,000 for a married joint taxpayer. Now that is calculated by the sale price, less your selling expenses, less your basis in the property. Basis in the property meaning what you paid for it, plus any major improvements. You're also going to need to know, when the property was purchased, because you do have to have your qualifying 2 out of 5 years residency. It does not have to be consecutive, so it's 2 years out of 5 years, not consecutive. And ownership, you have to meet the ownership test also to qualify for this. There are some exceptions if you have to move so many miles for a job or a health condition, but typically you're talking about anybody that have been in their home for years, whatever. They more times than not they're able to exclude the total gain unless you're going over $500,000 in gain, not purchase price, not sale
so
price.
If they bought it for $300,000, did some improvements, this market went crazy, they sell it for $750,000. Actually, that would be more than enough. If they sold it for $900,000, they could exclude that $500,000, so they'd only have capital gains on maybe about $100,000.
Right.
Perfect. And then you could deduct if you had to put a new septic in, a new roof, a new well. Okay.
That would get added to basis.
Perfect.
So when you're talking about a second home or investment property, of course we're talking about that being taxable. Usually your tax is going to be anywhere between 0 and 20%, but what I find commonly is that most people are laying in the 15% bracket.
Okay.
Unless you have really low income and you're at the 0, or really high income and you're at the 20%, but generally you're going to be in that 15% bracket. And then don't forget about Wisconsin. Now Wisconsin exempts 30% of the gain, and then you just go through the ordinary income process, the tax rate.
Okay.
I always figure about 5% for Wisconsin.
So if you have somebody who has, I think one of my clients had asked me, okay, so I own like a home on like 400 acres. So they wanted to sell the home off and then each 100 vacant lot after. Is there any tax ramifications or difference in how they protect those vacant lots off of the main building? Or is that all considered part of one? No, it's not, because the sale times would be all different.
Right. If you're splitting it off, that split off is becoming, a different parcel. It's not your principal residence anymore. But what I like to do, which seems valid to me, is that you take that original purchase price and you can allocate, some of that original purchase price over there. Of course, we're not talking about the bulk of it because that's not where the principal residence lands or sits. But you can take something over there, something reasonable, whatever the value of that was when you purchased it.
And then I know that if you have a husband and wife and somebody passes away and one spouse is left as holding the estate or the trust or the property, generally one of the things that we usually talk to people about is getting a record of the value of the property at that time.
Yep,
is that
on the
generally
date of death.
Okay, because that helps them have a basis going forward in time, correct?
Yes.
Okay.
So that's called the stepped up basis. So when you inherit property through death, and it's not just spouses, it's children.
Okay.
If you're inheriting property through a death, not a gift that was given to you from the owner, during their lifetime, that doesn't apply. You will get a stepped up basis, which is basically the fair market value on the date of death.
Okay.
Being in Wisconsin, with us being a community property state, some states you only step up the spouse who's deceased, but in Wisconsin you step up both sides because we're a community property state.
Okay. All right, makes sense. Are there any tax benefits for home sellers who have lived in their property for a really long time? It was grandma's place, they've owned it for 50 years up here, they're going to sell it now, and they're just curious. Do they have any tax benefits for the longer they're
Are
staying
we
there.
saying that it was not principal residence? So we're talking about
Second home.
a cabin, second
Yeah.
home. So depending on how you received the property, right?
Okay.
Because if you received it through a death, through an inheritance, of course you would have the stepped up, basis on the date of the death from the previous owner. Say it
Okay.
was grandma's, right?
Right.
Grandma passed away, left it to the son. Well, now you have stepped up basis. You're going to use whatever that basis is, so it's important. If it's gifted, a lot of times you carry over the basis of the previous owner, which is what they paid for it years ago. So that's why step up is so important, because you could be stepping up by, several
Significant.
$100,000.
Especially if
Right.
it's generational property.
Right.
So there's interesting. So almost better to do it that way than to gift it.
Yes.
Oh, yeah.
A lawyer will tell you to gift it so that the nursing home can't take it. And us accountants will tell you to no. Death is the ultimate in tax avoidance.
Wow. So very subtle nuance. I always think it's interesting, like when you talk to financial planners, accountants, and lawyers, like they're all looking at it from a totally different
Right,
perspective. So
right.
it's always
We
interesting.
do not agree. Yes.
Yep, I love it. That's why we do this, right? Okay, what records and documentation should I keep when selling my home for tax purposes?
So when selling your home, of course, we're going to be looking at basis, right? Unfortunately, before this whole principal residence exemption came into play, it used to be under the old rules that if you were 55 or older, you can exempt a property once, and buy a property that was more expensive or what. I'm sorry, downgrade. I said that wrong. Now, a lot of people don't have those records. Like, they don't know what they originally paid for it, when they originally
Yep.
purchased it. So you have to try to do what you can to get that basis together. Many times they're not reaching, say it's a Mary Joy tax return, they're not reaching that $500,000 exemption.
Okay.
So there's wiggle room there, just do the best you can, right? But now, going forward, you should be keeping those closing documents, and you should be keeping the sale documents if you're selling or you're buying. If you're buying, you want to track your basis. If you're selling, well, you're going to have your 1099 that the tax preparer needs, your closing statement.
And usually the title company gives you all of those things at the time of closing, so it's not stuff that you have to worry about getting for yourself.
However, just know that you got it you received it at the closing,
True.
because a lot of people are waiting for that stuff to come in January, and it doesn't come in January. You have it in your folder already.
That is very true, because we get a lot of calls like, "What are you going to send me
Right.
Yeah, and we say you've got it already. It's in
Right,
your file.
right.
So interesting, very interesting. And I think the main thing for most people to know is, again, that they're given it at the time of closing. They just have to hold on to it to
Yes.
pull it out.
Yes.
And that's usually unless they're preparing their taxes by themselves. Usually, I would assume their tax professional should be prompting them. Anything major happened this year?
Yes.
Do
Yes.
we have anything that we need to be
Yes.
reporting?
Now, if you do have a second home and you have a substantial gain, you need to see your tax preparer anyway, because you probably need to make an estimated tax payment.
Yeah. Oh, good point. Perfect. Okay. All right. Are there any tax implications if I sell my home at a loss, and can I deduct the loss?
Absolutely not. The government
It's funny
only
about
takes
that,
your
isn't
money.
that?
Principal residence in a second home, this is personal use. No different than your vehicle. You
Okay.
can't deduct a loss on that, and that's just the way it is. It's unfair, but it's true.
Yeah,
It's the
they're
IRS.
waiting there to take the gain, but they don't want to give you anything
Yes.
for the loss.
Yes.
Yeah. Isn't that interesting? Okay.